Hi everyone, welcome to our coverage of Uber's quarterly report Q2 23 from a couple of days ago. Check out our disclaimer, we're not giving you any investment advice as always. Let's start with the financials. So great results from the company perspective, first time ever quarterly operational profit, 326 million, and also free cash flow vastly exceeding their previous forecast. Also good numbers on the growth rates. User numbers grew by 12% year on year. Trips grew by 22%, which means more trips per user. Gross bookings a little bit behind trips growth as well as revenue, and that can be possibly explained either by more shorter trips and or by growth coming disproportionately from lower revenue countries. Then next, let's look at segment results. Here I've highlighted the 22 results. So we got the three segments, mobility, delivery, and freight. Mobility is what you used to know as Uber rides, so all the transport stuff of people, individual transport. Delivery is transport of goods. So it used to be Uber Eats, but now well and truly there's a lot more in that, like groceries, etc. And then there's freight. So a year ago, both areas were roughly the same. In fact, delivery had surpassed mobility for the first time, but growth rates have gone vastly different ways, 25% year-on-year growth in terms of bookings in the mobility segment and 12% in the delivery segment. And therefore, mobility is now again the largest segment. Pretty disastrous results in freight, but to be honest, I had never covered freight particularly in detail because unlike others, and forgive me if I say that, I had seen freight so far not as that promising thing that Uber themselves have made of it. But I'm more than happy to be proven wrong. Revenue even more accentuated the difference between mobility and delivery because of take rates. Take rates have always been higher in the mobility space and have accelerated to do so. The delivery space is more complex with three parties involved in that equation, as well as there's definitely more competition in that space, as we'll cover in a moment. So revenue by geographical region is a bit more complex, but we'll keep it very short. So on the surface, there's a 4% increase in the UCAN or US and Canada. That would have certainly crashed the share price had it not been driven majority by the 30-year decline in freight. That has led to a 20% decrease in that geography. So if you were to factor out freight, that would be 24% growth, which is pretty solid. Then very good numbers, if you wish, in the other areas, but keep in mind these come off the back of a very low basis. So different people will interpret the 30% differently. That's what I will say. Europe, so there has been the famous change in business model, in particular in the UK. The employees are now employees and no longer contractors or freelancers or whatever. And that has changed to a business model. It has led to a change of business model. And here's what they're calling out that has impacted. In a nutshell, here's a little bit more explanation. In a nutshell, what that has done is has moved pre-revenue dollars into post-revenue dollars. So pre-revenue costs into internal costs, or external costs into internal costs. And that has, on the surface at least, positively made the take rate look better, but what that means in terms of operating profit is a difference, and there's been no statement as to what that meant in terms of that. That would have been a lot more interesting, to be honest, but maybe they'll say something in the next annual report on that one. Let's continue. So income statement or statement of operations, same thing. It would be the most interesting figure from my perspective would be the direct cost, the variable cost, which is cost of revenue. But again, that has been impacted by this business model change. So looking at percentage of revenue for now doesn't work that well. Interestingly, I've also highlighted sales and marketing. Look at that, has stayed the same year on year, but revenue has grown a fair bit, 14% it was, I believe. So that's certainly a very good result to grow revenue without having to grow your sales and marketing. And we'll see their sales and marketing will grow, but whether it will notably reduce as a cost of revenue, that remains to be seen. Then here, balance sheet. So balance sheet normally not that interesting for us from a business model perspective, to be honest. But two things stood out, so that's why I'm calling it out here. One is the goodwill portion. Personally, I know other people see it differently, but personally, it was at 25% last year. Goodwill stood at 25% of total assets. I find that pretty high, to be honest. There's in their goodwill, there's certainly very good parts of it, like DD and Grab. These are certainly good parts of their goodwill portion, but there are also other parts which I'm not going to mention, which could see impairments. Nevertheless, very good balance sheet overall. The other thing that stood out, like very good in terms of total equity. Look at the other one that stood out for me because it may impact the future cost of revenue. Has been quite an increase in long-term insurance reserves. There's been no explanation as to why that is, but it has gone up by over 30%. So I thought that's worth a call out. Insurance costs are in the income statement under cost of revenue, and therefore I thought that's very interesting. They haven't done that for no reason. That's very interesting. We may hear more about it in the annual report. So now let's come to economics, business model, and strategy. Let's start with overall, but to be honest, a lot of this is relating to mobility. So overall trips grew 22%. The mobility trips grew by 26% even. Users 12% growth to 137 million. So that means that users per trip, trips per user grew from 5.4 to 5.6, which is obviously very important. Loyalty and returning users are the kind of the foundation of any business model, be it a digital or non-digital one. More than supply side. So here we see $839 US dollars per month for the drivers on average. Sounds not that high, but keep in mind this is across all geographies, including lower purchase power parity countries, and it is across full and part-timers as well. So if you were to look at a full-time driver in the US, that number would be much higher. We don't know what it is really. It's always been subject to a lot of discussion, but that's what it is for now. Mobility. So the supply side numbers and metrics have all gone up. According to Uber, the active drivers up by 33%, and supply hours per active driver up by 7%. Churn has been down. So that's kind of the key supply and demand side economics. Then overall strategy, and we'll talk about that a fair bit, has been to build the best-in-class verticals across mobility and delivery. Let's just jump to the next one where we'll pretty much see that those themes across key activities, key resources and assets, as well as the value proposition. So basically all of that means they're trying to use their same technologies and marketplace technologies to deliver and expand onto all sorts of verticals within mobility and delivery, and also to use AI and large data sets to improve customer experience and efficiency. And sounds a bit abstract, but on the next few slides, you will really see what that means. That is definitely the main theme of this update. Key partners, let's just quickly whip through this one. Key partners is definitely a growing list of merchants. So in gray, the ones that have been there forever and a day, not calling them out this time around. And then they have added Domino's as an exclusive partner. It was a big song and dance. You would have heard about it. It's a 12-month thing, after which Domino's can also use other delivery partners. Definitely what you'll see in the next few slides is an increasing level of differentiation in terms of their offerings, and I have found that to be particularly true for the lower cost segment. And the reserve feature, I'll say a few words. They've been talking about it a fair bit on the earnings call. Geographic expansion of offerings and features, definitely that is the main theme in terms of customer segments and growth. And we'll see, so here in the revenue section, we'll see all of that over the next few slides, so I'll skip that one. In terms of additional new types of customers, advertisers, so advertising offering has started a while ago, and they're growing that part of the business. Merchants, there's now an offer called Uber Direct, which I'm not going to cover in this presentation, but it is kind of a white label delivery service, which means the customer uses that via the checkout of the respective merchant, and it's basically not being shown that this is an Uber delivery. So the merchant will pay Uber, and they may or may not charge back the customer, but that's basically a new offering. And Uber for Business, yeah, I think we all heard about it. It's more around efficiency in terms of duty trips. And main channels, the new Uber app. I'll talk about it, but you almost certainly would have seen it. It came out earlier this year, I believe in around March. I'll say a few words towards the end of this presentation because it is fairly important. And tying into that, as well as basically the value propositions and the customer segments, is the Uber One membership. Again, I'll say more in a moment. So mobility updates that were mentioned at the earnings call, I found it very interesting, most of them were pertaining to lower cost offerings. So geographic rollout of upfront fares to all LATAM markets, plus pricing algorithm improvements. They saw increased trip conversions. Makes a lot of sense, of course, if you know what your ride will cost. And if that is acceptable, then you will accept it much more than not knowing the price. Then they launched Uber Taxi in a number of new markets. So basically, this is simulating competition. That's how I called it. I personally, when I talk to Uber drivers, quite a few of them have been ex-taxi drivers, and basically they're saying, well, if you can't beat the competition, you partner up with them. That's probably that part. Uber Moto, Uber X. So Uber X is what used to be Uber Express, Uber Pool, Uber Express Pool. It had many different names. Was seen as a major growth opportunity, and you just share the ride with other riders. Has been rolled out in 18 additional markets, now 50 markets globally. That's the biggest that it has been. It was pretty much wiped out during COVID because, yeah, you don't sit in a car with strangers, no social distancing. Yeah, it's back on the agenda and possibly a nice opportunity there. So basically, all of this is non-Uber X products that we're talking about here. And yeah, that's led to 8 billion in annualized bookings growth and 12% of the overall mobility bookings. Then what they're saying is these new offerings, they lead to more adoption and more return rates. So that is not necessarily surprising, and it could stay that way. Let's just add one caveat, which is that this is really a small data set for now, because all of these offerings are new and they're not in all markets yet, but it is also explainable with demand elasticity economics, basic economics, lower price, more uptake, and same type of people come back. Then other updates in regards to mobility. So I'm not going to say too much here. Uber Reserve, that's basically where you can reserve up to 30 days ahead of time. Interestingly, always I have found, and this time they said they improved the airport pickups. Well, interesting. What do you do with if your flight arrival time changes? They're probably tracking other data sources to deal with that. Uber Car Share expanding to North America. That's the unit that's the startup that basically was here in front of my house door that they've bought up early last year for $50 million. They had been around for 10 years and been somewhat struggling to grow. So maybe Uber with their customer base can make something interesting out of it. I'll skip the other ones because we don't want to go overboard. So the main themes for growth in terms of mobility offering, they want to grow in their major markets and argue that they are at low penetration. I always find that that is not an argument, to be honest, because, I mean, cynically speaking, even like a crappy product could say, wow, yeah, look at the opportunities we got. We got 0% market share. We can grow to 100%. What they're obviously trying to say is, excuse me, compared to other tech giants, let's say like Android or Facebook, they're not at 50 to 70% of mobile phones penetration, so they could go a long way, but who knows what is going to be the end penetration of ride hailing. Nobody knows that. One could find it out, could get closer to it by doing demand and supply elasticities, but since they're not providing any details on that, that argument alone doesn't quite work in my mind. What works a bit better is they want to grow in non-core cities in their major countries like UK, Canada, etc. And they're saying that they've seen growth in cities like Manchester and Birmingham, but I have to say they have improved pricing and provided incentives. And then there's always the question, what happens if the improved pricing disappears and has to be taken out? That's always the caveat there, but it does make sense that it can work, provided that the supply side is also there to keep prices low. Then the third one is growth in major economies with current low penetration. With current low penetration to similar levels than other major economies. Again, that can make sense. So grew 135% year on year. It's very, very solid growth rates there in these countries. They haven't said anything, interestingly, to the lower or developing economic countries. And that's interesting because most of these updates on mobility do address either those countries or lower income segments. So interesting that there was nothing. In any case, let's move on now. Delivery. So delivery is Uber Eats, but also then growing into grocery, convenience, and alcohol and other things. Definitely, if you have looked at the app, there's a lot more there now that you can have through the Uber delivery part. They say that the macro environment is positive and demand side has been growing, gross bookings 14% year on year, and delivery frequency 4 monthly orders per eater, which is an all-time high. So those basic demand side economics are good. Supply side is where I would have questions. So they are saying merchants up 9% year on year. They haven't made any quantitative statements on delivery drivers. Broadly speaking, they're saying key input metrics have improved: average delivery time, cost per trip, and supply hours. Cost per trip, I'm wondering what that is. Is that the cost of the supply side? Because that leads to my key comments on this one. Competition is really fierce in the delivery space. There's not just DoorDash. There's all the bike delivery companies. Like here, we probably got 6 of them at least that I see every day. And then large retailers, if we talk about groceries, all of them have their own delivery trucks. So yeah, it's going to be really interesting. As we know, I'll show just say a few more words. The supply side cost base plays a huge role in the economics of such offerings. Delivery time and reliability. So if you compare a bike in an urban area, like a CBD area, that's going to be on par. Bikes probably are going to be even faster. They don't have any parking. They don't have one-way roads and all of that. They could be faster. And then in the early days when delivery came on and Uber Eats came on, Uber was really talking about network effects improving because they can now increase the utilization of drivers, but that only works if drivers take this work up. And car drivers in urban settings, I'm not entirely sure if that's going to be as favorable as anticipated or hoped for or required, simply because the cost base of a car driver compared to a bike will be higher. So therefore, the delivery fees will have to be higher. Let's have a look. So in our detailed premium resources, we've compared notionally the cost base of a taxi with an Uber, and how the financial operating model works. Again, this is basically referring to our premium resources, is gross booking value minus the cost base, has to cover the cost base and give a profit to the driver. Otherwise, nothing's going to work. The supply side will just disappear. And therefore, the higher their internal cost base is, the higher will be the cost to the consumer. And because of demand elasticity, that demand will shrink. That's pretty clear. And or the revenue will shrink. And that's also what we see in the take rates. The take rates are simply lower for delivery than for mobility. So all of that, and in addition, from a business model perspective, even though Uber accepts bike riders, they're not the top of mind for bike riding delivery guys. They're not necessarily the experts. They're with regards to onboarding. Some of the bike companies now provide gear like rain gear, etc. And there could also be differences in algorithms in terms of delivery time calculations, etc. So that is a very interesting space, highly competitive. Not saying that what Uber is saying is wrong, but definitely calling out the competition. So here, let's go back to what they are saying, deliver it. So I'm saying it's not just Uber Eats anymore. Let's jump to the app. Here, you probably or most likely would have seen this already. In your app, a lot of stuff in terms of delivery. Depends on your geographical area, but I can see a lot of things behind each of these, a lot of choice. Very interesting. So they got more than 100K merchants now and a run rate of 6 billion. And basically the way to grow is more verticals, more choice within the verticals, more merchants. That's that. There's increases in value propositions. You can read through these yourself. Domino's, I already said, it's a 12-month exclusive deal, but you already have the other ones like McDonald's and so on. You already have there. If I look in my geography, the delivery costs are between $1 and $8, or actually $9. And where it's $1, it is almost certain that the merchant subsidizes this. It's going to be very interesting to see how that all pans out. Part of all of this that glues everything together is the loyalty program, which is a cross-platform one. So basically, you can accrue a cash benefit or a cashback benefit, which you earn on your mobility rides, but you can use them cross-platform, so you can use them on delivery as well. And I think they said 14% was used on delivery, earned on mobility, but used on delivery. So it's a cross-platform effect. They are basically, it's like the traditional cross-selling, if you wish. And the program has generated 27% of gross bookings. So basically what a loyalty program is supposed to do is to increase or stimulate consumption. So pretty solid numbers there, at least it seems so. Advertising, relatively new segment, and 650 million revenue run rate, which 400K advertisers and makes 1,500 per merchant advertiser. Interestingly, freight again, other updates, they entered a partnership with Waymo from Google or Alphabet. Very interesting, but it's a more long-term thing. And this personally, I find this very fascinating.